So yeah, I've got to be honest with you, what I'm about to share today could literally change the trajectory of your financial life. You know what? Most people are working incredibly hard for their money, but their money isn't working hard for them. And that's exactly what I'm here to change. My name is Mike, and I've spent years, studying finance, investment strategies, analyzing markets, and learning what actually works when it comes to building real wealth. And here's the thing. I'm not here to sell you some course or give you financial advice that only works if you're already rich. I'm here to break down the exact assets that everyday people can use to start generating passive income and building wealth, starting right now. Now hold up, before you think this is just another get-rich-quick scheme or some overhyped nonsense, hear me out. What we're diving into today is about building real, sustainable wealth through income-generating assets. Not gonna lie, when I first discovered these concepts, I was pretty skeptical myself. But after seeing the results, both in my own portfolio and in the portfolios of countless others, I'm a believer. For sure. At the end of the day, wealthy people don't stay wealthy by just earning a salary. They build wealth by owning assets that generate income while they sleep, while they're on vacation, while they're literally doing nothing. That's the secret sauce right there. And if you stick with me through this entire video, you're going to understand exactly which 5 assets can do this for you and, more importantly, how to actually acquire them without needing to be a millionaire first. Sounds good? Let's get into it. So first up, let's talk about dividend-paying stocks. All right, probably the most accessible income-generating asset out there is dividend-paying stocks. Now, I know what some of you are thinking, Mike, stocks are risky, I could lose everything. Well, hold up, let me break it down for you because there's a massive difference between speculative trading and strategic dividend investing. Here's the thing. When you buy shares of a dividend-paying company, you're essentially becoming a partial owner of that business. And just like any business owner, you get a share of the profits. These companies distribute a portion of their earnings to shareholders on a regular basis, usually quarterly. So basically, you're getting paid just for owning the stock. That's crazy, right? But here's the kicker. Not all dividend stocks are created equal. You want to focus on what I call dividend aristocrats. These are companies that have not only paid dividends consistently for decades, but have actually increased their dividend payouts year after year for at least 25 consecutive years. We're talking about stable, reliable companies with proven business models. To be fair, the average dividend yield you're looking at might only be around 2-4% annually. You might be thinking, that doesn't sound like much, but let me repeat that. This is passive income that requires zero effort once you've made the initial investment. Plus, if you reinvest those dividends through a DRIP, that's a dividend reinvestment plan, you're buying more shares automatically, which means more dividends, which means more shares, and so on. It's compound growth in action, you know what I mean? But hold up, here's where it gets really interesting. Over a 30-year mortgage, your tenants are essentially buying that property for you. By the time the mortgage is paid off, you're collecting nearly the full $2,500 monthly rent as profit. Plus, if the property appreciates at just 3% annually, which is below the historical average, that $300,000 property could be worth over $700,000 in 30 years. That's crazy. Now, to be honest, being a landlord isn't for everyone. You've got to deal with tenant issues, maintenance calls at 2 a.m., vacancies, and all that fun stuff. But here's the thing. You can hire a property management company to handle all of that for you. Yes, they'll take about 8-10% of your rental income, but if you value your time and sanity, it's worth every penny. You get me? Just saying. I've seen people build incredible wealth through real estate. Some investors start with a single rental property, then use the equity and cash flow from that property to finance a second one, then a third, and so on. Before you know it, they're managing a portfolio of properties generating six figures annually in passive income. And by the way, there are tax advantages to real estate investing that you won't find with most other assets. Depreciation, mortgage interest deductions, property tax deductions. These can significantly reduce your taxable income. That being said, real estate isn't liquid like stocks, and it requires active management or the cost of hiring managers. Basically, if you can save up for that down payment and you're willing to learn the game, rental properties can be a game changer. Here's one that doesn't get enough credit: index funds. All right, the third asset. And this is one that honestly doesn't get enough credit for how powerful it is: index funds and ETFs. Now, I know some of you might be thinking, wait, didn't you already talk about stocks? Well, sort of, but this is different. Let me explain. Individual dividend stocks are great, but they require research, monitoring, and active decision-making about which companies to invest in. Index funds and ETFs, on the other hand, give you instant diversification across hundreds or even thousands of companies with a single investment. You know what? It's like buying a slice of the entire market instead of betting on individual players. Here's the kicker. Study after study has shown that over the long term, index funds outperform the vast majority of actively managed funds and individual stock pickers. I mean, we're talking about something like 80-90% of professional fund managers failing to beat the market over a 15-year period. That's insane. So why try to beat the market when you can simply match it and still come out ahead of most investors? Let me break it down with an example. The S&P 500, that's an index of the 500 largest U.S. companies, has historically returned about 10% annually over the long term. If you invest $10,000 in an S&P 500 index fund and just let it sit for 30 years with that average return, you're looking at over $174,000. If you add just $500 per month to that investment over those same 30 years, you'd have over $1.1 million. Let me repeat that. Over $1 million from consistent, boring index fund investing. To be fair, index funds don't pay out as much in dividends as dedicated dividend stocks, but many of them do pay dividends, and the growth potential is substantial. Plus, the fees are incredibly low, often less than 0.1% annually, which means more of your money stays invested and working for you. That makes sense, right? Honestly, though, the beauty of index funds is in their simplicity. You don't need to be a financial expert. You don't need to spend hours researching companies. You just invest consistently, reinvest those dividends, and let compound growth work its magic. It's basically the set it and forget it approach to wealth building, and believe it or not, it's one of the most effective strategies out there. At the end of the day, index funds and ETFs are perfect for anyone who wants to build wealth but doesn't want to make investing their full-time job. So yeah, if you're not already investing in index funds, you're honestly leaving money on the table. For sure, this should be a cornerstone of anyone's investment portfolio. Now, here's where it gets really interesting creating digital assets. Now, the fourth asset is where things get really interesting creating digital products and intellectual property. Hold up, I know this might sound different from the traditional assets we've been talking about, but hear me out, because this is where you can create something from nothing and generate income for years or even decades to come. Here's the thing. When you create digital products, whether that's online courses, ebooks, software, apps, stock photography, music, templates, or any other form of intellectual property, you're building an asset that can generate income with minimal ongoing effort. I mean, you create it once, and it can sell thousands or even millions of times. That's the ultimate form of leverage. You know what I mean? Let me break it down. Say you're an expert in something, doesn't matter what it is, could be graphic design, cooking, fitness, programming, whatever. You can package that knowledge into an online course and sell it on platforms like your own website or various online learning marketplaces. If you price that course at $100 and sell just 10 copies per month, that's $1,000 in monthly passive income. But here's the kicker. Once that course is created, selling 10 copies takes the same effort as selling 100 or even 1,000 copies. It's infinitely scalable. Or maybe you write an ebook. Sure, you might spend a few months writing and editing it, but once it's published, it can generate royalties for the rest of your life. Not gonna lie, I know creators who wrote books a decade ago that still generate thousands of dollars annually in passive income. That's crazy, right? Software and apps are another massive opportunity. If you can code or you can hire someone to build an app that solves a problem people have, you can generate income through sales, subscriptions, or advertising. Just saying. To be honest, this asset class is incredibly accessible because the barrier to entry is relatively low. You don't need tens of thousands of dollars to get started, mostly just your time, skills, and creativity. And by the way, this is exactly what I'm doing right now with this YouTube channel. Every video I create is a digital asset that can continue generating ad revenue, sponsorships, and audience growth long after I hit publish. You get me? The key here is to create something valuable that people actually want or need. If that makes sense, think about problems you can solve, knowledge you can share, or entertainment you can provide. Honestly, though, the income from digital products might start small, but as you build a library of products and grow your audience, it can snowball into a significant income stream. At this point, some creators are making 6 or even 7 figures annually from digital products alone. No kidding. And finally, the stability, play high yield, savings, and lending. All right, we've made it to the 5th asset, and this one is a bit different but super important peer-to-peer lending and high-yield savings vehicles. Now, I guess this might sound boring compared to real estate or creating products, but hold up, because this asset class offers a unique combination of passive income and relative safety. Here's the thing. Traditional savings accounts at big banks pay practically nothing these days. We're talking maybe 0.5% interest if you're lucky. But with high-yield savings accounts, online banks, and credit unions, you can earn 4 to 5% or even higher on your cash reserves. Let me repeat that. Your money is sitting there doing nothing but earning you income, and it's FDIC insured up to $250,000. Now, let me break it down with some numbers. If you have $50,000 sitting in a traditional savings account earning 0.5% interest, you're making about $250 per year. But if you move that same $50,000 to a high-yield savings account earning 4.5%, you're making $2,250 per year. That's an extra $2,000 annually for literally doing nothing except moving your money to a different bank. That's crazy. But wait, there's more. Peer-to-peer lending platforms take this concept further by allowing you to lend money directly to borrowers and earn interest rates that can range from 5% to 15% or even higher, depending on the risk level you're comfortable with. Basically, you're cutting out the traditional bank and becoming the lender yourself. You get me? To be fair, there is more risk with P2P lending than with FDIC-insured savings accounts. Borrowers can default, and you might lose some or all of your investment in individual loans. That being said, most platforms allow you to diversify across hundreds of different loans with small amounts like $20 per loan, which significantly reduces your risk. Just so you know, I've experimented with P2P lending myself, and the returns have been solid, averaging around 6 to 8% annually after accounting for defaults and fees. It's not going to make you rich overnight, But as part of a diversified portfolio, it adds another income stream that's relatively passive. The beauty of these savings and lending vehicles is that they provide stability and income without the volatility of stocks or the management requirements of real estate. At the end of the day, a well-balanced wealth-building strategy includes a mix of different asset classes. You've got your growth assets like stocks and real estate, and you've got your income and stability assets like high-yield savings and peer-to-peer lending. So yeah, let's recap what we've covered here today because this is important stuff. We've talked about 5 powerful income-generating assets: dividend-paying stocks that pay you just for owning them, real estate rental properties that provide cash flow, equity building, and appreciation, index funds and ETFs that offer diversification and long-term growth with minimal effort, digital products and intellectual property that you create once and sell repeatedly, and peer-to-peer lending plus high-yield savings vehicles that provide steady, reliable income. Here's what I was thinking. You don't need to choose just one of these. In fact, the most effective wealth-building strategy combines multiple asset classes. You know what? Start with what's most accessible to you right now. If you've got a few $1,000s saved up, maybe start with index funds and high-yield savings. As you build more capital, add dividend stocks to the mix. When you've accumulated enough for a down payment, consider that first rental property. And throughout all of this, work on creating digital products that leverage your unique skills and knowledge. At the end of the day, building wealth isn't about getting lucky or finding some secret loophole. It's about consistently investing in assets that generate income and grow in value over time. I mean, anyone can do this. You don't need to be born into wealth. You don't need to be a genius. You just need to start and stay consistent. If you ask me, the biggest mistake people make is waiting for the perfect time to start investing. Let me tell you something. There is no perfect time. The best time to start was yesterday. The second best time is today, right? Even if you can only invest $50 or $100 per month right now, start. Those small amounts compound over time and build momentum. So here's what I want you to do after watching this video. Pick one asset class from what we discussed today, just one, and commit to learning more about it. Watch more videos, read books, take a course, whatever it takes. Then set a goal to make your first investment in that asset class within the next 30 days. That's it. Just start. Because once you make that first investment, everything changes. Believe it or not, 10 years from now, you'll look back at this moment and be incredibly grateful that you started today. The version of you in the future is counting on the version of you right now to make smart financial decisions. Don't let them down. To be honest, this is some of the most important financial knowledge you'll ever learn, and I'm honored that you spent this time with me today. Just saying, if you found this valuable, hit that like button, subscribe to the channel, and drop a comment below letting me know which asset class you're most excited to invest in. All right, that's all I've got for you today. Remember, the path to wealth is paved with income-generating assets. Start building yours today, stay consistent, and I'll see you in the next video. Until then, keep learning, keep investing, and keep building that financial future you deserve. Peace.